So good afternoon, friends. I hope I'm audible and visible.
Yes, sir.
Okay. So friends, I hope you people tried the questions which I gave to you. Okay. So let me move forward. Okay. So portfolio management and overview. This is something first we are going to talk about it. Then we will move forward. So once again, good afternoon, everyone. Those people who have joined recently. I hope you all are doing good. You all are fine. Okay, great. So let me see. See, we know what is the purpose of creating a portfolio, and why anyone should have portfolio instead of putting all the money at one place. Why anyone should actually create portfolio? Because ultimately the purpose is to achieve the highest possible return at the same level of risk, or to achieve a level of return at the lowest possible risk. So these are the two things. So if we talk about any investor always, a rational investor always tries to lower down the risk, and a rational investor always tries to maximize the risk. So why should we create portfolio? This thing we have seen in the last class also, because if we put different asset class in our portfolio, if we create a diversified portfolio, then what happens? It reduces the risk. So let me see. It reduces the risk at a given level of expected return. So if we want to achieve a level of return, and if we are creating a diversified portfolio, so what happens? We are able to achieve it at the lowest possible risk. That is the benefit. Okay. For example, there are two things. One is I can invest in an individual security. For example, there is a company called X. I can invest in that company, and that company, by investing in that company, I can earn a return of, let us say, 20%. And there is a fund, there is a portfolio XYZ. If I invest my money in that fund, again, for example, the return expectation is 20%. So as a rational investor, I will always opt for this portfolio or this fund, because here what is happening, different securities are included. And if different securities are included, then the portfolio risk is actually lesser than this, the risk of individual security. So that is the benefit of diversified portfolio. Now there are different professors who came up with the modern portfolio theory. So like Trainer, Sharp, Mawson, Linter. So different actually, if we say professors came up with their, you can say, research. And they said that if we are able to create a diversified portfolio, then what we can do, we can actually reduce the risk. We can actually reduce the risk of the portfolio. If I take the risk individually, so let us say there are 5 securities. If I take their risk individually and I take the on an average, then the risk would be greater in comparison to if I calculate, we can say, portfolio risk. अगर 5 सिक्योरिटीज हैं, पांचों सिक्योरिटीज को रिस्क को मैं क्या कर रहा हूं, For example, in one security risk is 20% risk, means standard deviation I am talking about. In another security risk is 15%, then other security 13%, then other security, let us say 12%, and then other security, for example, 10%. And let I say the average is 15%. So if I take all these risks individually and take the average, it is coming 15%. But if I create the portfolio, so definitely what will happen, my portfolio risk would be lower than this 15%. So that is the benefit of creating a portfolio. I hope this point is clear. Nandini, is it fine?
Yes.
Shavin? Shanay?
Yes, sir.
Okay, okay, great.
Yes.
Okay. So now what we can do, we can find out a ratio called diversification ratio. So what is that ratio? You can see it is calculated as the ratio of the risk of an equally weighted portfolio of n securities. So for example, different securities are there. Okay. Again, you can see it is calculated as the ratio of the risk of an equally weighted portfolio. So there is an equally weighted portfolio. Equally weighted portfolio means, for example, if I am creating portfolio of 4 securities, so 25% is put in A, B, C, D. In all the securities, 25% money is invested. Okay. To the risk of a single security selected at random from n securities. So if any security is selected from all those securities, so if we take the ratio of these two, it means risk of the portfolio and risk of individual security. So if we take the ratio of these two, this is called diversification ratio. So logically means, let us say that the portfolio risk is coming out 15% and that individual security risk, or let us say the on an average risk of all the securities. I am not talking about portfolio risk. I am talking about on an average risk of the securities. So it comes out as 20%. So you can see it means definitely there is a benefit of diversification. That is why in numerator my risk is lesser. So lower this ratio, it means more diversification benefit is there. So for example, it comes out as 0.75 and it comes out as 0.60. So what do we mean by it? It means here, if we create the portfolio, so we are able to diversify more. We are able to reduce the portfolio risk more in comparison to this situation. So that is basically what that diversification ratio tells us.
So in the numerator, we have the portfolio risk.
Portfolio risk, yes.
And
it means when we are talking about portfolio risk, it means we are considering the effect of correlation, covariance also. Are you getting the point? If you remember, yes.
And the 15% that you took, मतलब आपने बोला वो average of all stocks तो portfolio risk नहीं हो गया?
नहीं.
अच्छा,
average का मतलब हुआ, या तो मैं नीचे क्या कर सकता हूं, either I can take only one security risk, or even what I can do, I can take, for example, 5 securities are there. I am not creating portfolio risk, but I am simply taking average of that risk.
Okay.
Are you getting my point? So if I simply take average of my 5 securities risk, that is not portfolio risk. Because portfolio risk consider what? Relationship between the different assets also. I hope this is point clear now.
Yes.
Okay. क्योंकि हमने last class में formula किया था ना, when we talk about portfolio risk, so that is weightage of 1 square into standard deviation of 1 square plus weightage of 2 square into standard deviation of 2 square plus 2 into weightage 1, weightage 2, standard deviation 1, standard deviation 2, and also we consider what? Correlation also. So when we talk about portfolio risk, it means we are considering correlation and covariance also. If we are talking about, you can say average of risk of different securities, it means we are not considering that correlation or covariance. Now, what are the steps in portfolio management process? Simply, first we have to plan. If I have to create portfolio, for example, for any client, so it depends upon many factors. It means client return objective, for example, how much client is thinking of, how much return should be earned from the portfolio, how much risk the client can take, what are the different constraints. All these things will come in detail in the next chapters. What are the preferences? Okay, then we have to, once we have created the portfolio, we have to review it periodically. An investment policy statement. So this is a statement according to which, as a portfolio manager, I invest. Okay, now once I plan that, okay, to achieve the different, what are the objectives of the client, and to achieve the objectives of the client, where I should invest the money, what are the constraints, what is the risk tolerance level, everything. If I plan, then we have to execute it. So for example, we have created a plan. According to that, I should put 50% in equity asset class. Okay, 20% in debt asset class, and let us say 30% in alternative investment asset class. So I will start executing it. Okay, so you can see, construct the client portfolio by determining suitable allocations to various asset classes based on their IPS and expectations about the macroeconomic variables like inflation, interest rate, GDP growth rate. So when I actually plan, when I did the planning, I considered all the macroeconomic factors also in my planning. तो हमने क्या किया, प्लान करने के टाइम पर जो भी मैक्रो इकोनॉमिक फैक्टर्स हैं या जो भी माइक्रो इकोनॉमिक फैक्टर्स हैं, उन सबको कंसीडर किया. ओके, फिर अगेन क्या करते हैं, फॉर एग्जांपल लेट अस से 50% ऑफ द मनी इज टू बी इन्वेस्टेड इन इक्विटी. देन फर्दर इक्विटी वेयर. So again, what I can do, I can use top-up approach, top-down approach, or bottom-up approach. In top-down analysis, what happens? First, we understand the economy, then industry, then company. In bottom-up analysis, what happens? First, we identify a very good opportunity of investment. It means first we look at the company's profile, company's fundamentals. Then we talk about the, you can say, industry, and then we talk about the company. Talk about the economy. Now, once it is executed, so the purpose, or we can say the work, is not over for portfolio manager. Now, there will be different kind of changes in the investor's profile. भाई मान लीजिए आज हम सोच के चले थे कि इन्वेस्टर को क्या चाहिए. इन्वेस्टर डू नॉट नीड एनीथिंग बिफोर 5 years. इन्वेस्टर को अभी 5 साल से पहले कुछ नहीं चाहिए. Investors' objective, financial objective, will come only after 5 years. But there might be a change. There might be a change in the situation, and it might happen that after 2 years itself, my client need money for some purpose. And if we withdraw money from the you can say investments, तो हमारा पूरा का पूरा जो हमने प्लानिंग की थी वो सब गड़बड़ा जाएगी, सब बिगड़ गई. So what I will do, I will rebalance the portfolio, and again there can be macroeconomic changes. For example, let us say we expected the inflation to be, for example, 5% for long term. But what happens? Let us say inflation is 10%. So I created the plan according to 5% inflation. I invested the money according to 5% inflation, but it is actually 10%. So again, it will create problem. So again, what I need to do, I need to rebalance the portfolio. I have to review the portfolio. So that kind of things. So there can be microeconomic changes, there can be macroeconomic changes. So accordingly, it is a continuous process. It is not one-time process that we have created a plan for the client and that's it. So again, my client will invest according to this and his or her life will be easy. No. So we have to continuously review it. Are these points clear to you? Okay. So now we can see there can be different kind of investors. So let me come over here. So it will give you more idea, the summary. So there can be investors like individuals, you and me. If we talk about the risk tolerance capacity, so how much is the risk tolerance capacity? It depends upon individual to individual. So for example, my risk tolerance capacity is high. And there might be another person whose risk tolerance capacity is low. For example, let us say I have very good finances available with me. If I have very good finances available with me, then I can take more risk. There is another individual who is having very less finances, so that person cannot take much risk. So his risk taking capacity will be low. So it depends upon individual to individual. Investment horizon, for how much time period it is to be invested, again it depends upon individual to individual. Liquidity needs, again, when the money is required. What do we mean by liquidity needs? When the money is required. So every individual has different life objectives. For example, your life objective can be that you want to start a business after 2 years from now, so you need money after 2 years also. Then you want to buy a house after 5 years. You want to buy, for example, a bungalow after 20 years. You want to buy, for example, a charter plane after 25 years. So your requirement can be different from my requirement. So it depends upon individual. Income needs, it means from the investment, do we want any sort of income, any sort of cash flow? So again, it depends upon individual. So this is individual. Banks, again, banks can be invested. So if we talk about the risk tolerance capacity, so generally banks take lesser risk. So whatsoever money they have, they take less risk, because ultimately they have to give the money back to those who have deposited the money. तो जिन लोगों ने पैसा दिया है, for example, as an individual, I go to the bank, I deposit my money in the form of fixed deposit. So now what that bank will do? Bank will invest it. What do we mean by investment there? It means bank can give the loan from that money. So that is again a kind of investment for the bank only. So the risk tolerance is low. Again, there might be a possibility that bank is investing some of its money in some financial investments. So they will take less risk, because ultimately liquidity is very high. Liquidity requirements are very high, because if client come and ask money from the bank, it is you can say it is mandatory for the bank to pay the money. So because the liquidity needs are high, that is why they can take less risk. So investment horizons short. So that is why if banks have some excess money, so they invest in very short-term investments. So income needs, yes, interest, because banks have to pay interest. So they have income needs. Now endowments. Endowment means, you can say, a kind of fund which is created for a specific purpose. Which is created for a specific purpose. So let us say we are creating an endowment. For example, I am just giving an example that I want to replace this machinery after 8 years from now. So I want to replace this machinery 8 years from now, 10 years from now. For that, I have created a kind of fund. So risk tolerance is high because the period is defined. And generally the time period is larger. So because the investment horizon is long, so that is why generally risk taking capacity is high. Liquidity needs are low. Income needs, so whenever we have to spend the money, then only we need income. Now, if we talk about the insurance companies, again, what is the objective of an insurance business? It means the customers have given money to the insurance company. Why they have given money to the insurance company in the form of premium? That if any uncertainty happens for which they have taken the insurance, then it is the liability of insurance company to make arrangement of funds for that. So for example, if there is any individual who has taken insurance on, let us say, car. So if the insurance is taken on car, and if the car met with an accident, so it is the responsibility of the insurance company to make up for the loss. So it means, because they cannot, again, if we say their liquidity needs are very high, because they might need money quickly. So because liquidity need is high, so insurance risk tolerance is low. Again, investment horizon, there can be life, there can be, we can say, non-life. Non-life is property and casualty. So if we talk about the life insurance policies, so the time horizon, investment horizon is long, because generally if any person takes life insurance policy, so belief is that person will live for a long period. But what might happen, let us say from 1 lakh people, there is a possibility that there is a premature death of, let us say, 100 people. So out of 1 lakh, only 100 will die prematurely. So it means the money will be invested for a long time period. But if we talk about property and casualty, it means non-life insurance policies. If we talk about, so investment horizon is short, because recurring, it is on recurring nature. Okay, so income need is low. Mutual funds, where risk tolerance, so it depends upon the fund. There can be money market related instruments, so the risk tolerance is very low. There can be, for example, balanced schemes, so we can say risk tolerance is moderate. There can be small cap schemes, money is invested in small companies, risk tolerance is very high. Okay, so that kind of thing might happen. Investment horizon, it depends upon the fund. Liquidity needs very high, because the investors can withdraw money at any time. So because the investors can withdraw money at any time, that is why mutual funds cannot simply invest all of the money into different investments. Income need again depends upon the fund. So for example, there is a mutual fund which is having growth option. So what will happen? That mutual fund scheme doesn't distribute dividend, so income need is less. But again, there is a possibility that there is a scheme which is dividend payout scheme, so they need income. Yes. Now there can be defined benefit pensions. What is this defined benefit pension? It means, as an employee, I am working in an organization, and that organization is saying to me, okay, on retirement, you will get this much pension. So for the time being, you can consider it. So that is defined benefit pension. It means pension benefit is defined. How much pension you will receive, how much pension employee will receive, that is defined. So logically think, for example, the age of an individual is 25, company is expecting that person to retire at 60 age. So what will happen? It means near around 35, company has near around 35 years to invest for this person. So risk tolerance is very high, because the investment horizon is very long. Liquidity needs low. For this individual, the money would be required after 30-35 years. So liquidity needs are low. Income needs depends upon the age. So these are the different, if we talk about different investors, so this is the different risk, liquidity needs, income needs, and investment horizon. Sarthak, is it fine?
Yes, sir.
Siddhi, is it fine?
Yes, sir.
Okay, great. Now, again, we can have two type of plans. One is defined contribution, one is defined benefit. So I think in this group there someone was doing CFP. Yes. Siddhi, are you doing CFP?
Yes, sir, I have cleared.
Okay, great. So Siddhi, can you just tell us what is defined contribution plan, what is defined benefit plan?
Defined benefit plan are the plans which you right now said that they are already defined by pension fund managers, and defined contribution plans are according to the employer. Like for example, EPF, PPF, all these come in defined contribution plans, and defined benefit in defined benefit plans there are investment instruments like gratuity. All of these come in defined benefit plan.
Okay. So let me see. As the name says, defined benefit plan. It means benefit is defined. So for example, you must have heard there was a time, and if we talk about the government employees who were employed before, for example, 2004. So what kind of pension they get? They get defined benefit pension. And nowadays, there is a pension called new pension scheme. So that is defined contribution. So now let us see. Defined benefit, it means benefit is defined that, okay, after this time period, you will get this benefit. So for example, the contract, the employment contract says that when you will retire, so what will happen? You will get what? When you will retire, you will get 50% of your salary as a pension. It means whatsoever would be your last salary, you will get 50% of it as pension during your rest of the life. So this is called what? This is called defined benefit plan. And there can be defined contribution plan. What do we mean by it? Now, one employer says that, okay, you will receive some pension on retirement. Okay. But for that, we need to contribute. It means you will contribute, we will contribute, both will contribute. Here also the contribution was happening. It means the employer was doing the contribution. For example, employee was doing the contribution to create a fund from which salary will be given. But here, what employer said, okay, whatsoever fund is created, we are not restricted to that. Even if that fund is not sufficient, although it is described, it is defined कि कितना कितना आपको देना है, definitely both the parties are giving. But again, let us say there is a shortage in this fund because of any reason, because of, let us say, investment rate. Then who will bear the risk? Who will bear the risk? Employer will bear the risk. It means what employer will say, okay, the fund requirement was 1 crore, but because the fund is created only for 80 crore rupees, so whatsoever is the shortage, I will make up for that. So who is assuming the risk? Employer is assuming the risk. Now another kind of arrangement, again both are contributing, employer and employee. And what employer has said? Employer कहता है देखो, we both are contributing. जितना आपका कॉर्पस क्रिएट होगा, I am going to pay you according to that corpus. It means I am not going to make up for any shortage. Whatsoever fund is created, that fund belongs to you. So accordingly, I will give you the money. So I am not defining how much benefit you will receive. The benefit depends upon the corpus created. So here, if there is a shortage of fund, then who will have to assume the risk? The employee has to assume the risk, because the fund is less, so accordingly pension will be less. So this is defined contribution and defined benefit pension. I hope these points are clear to everyone.
So the second example that you gave for the defined contribution, I didn't understand that. Like पहले केस में दोनों like employer employee contribute कर रहे हैं,
इसमें भी दोनों contribute कर रहे हैं, लेकिन यहाँ पर दोनों contribute कर रहे थे, फिर भी employer ने क्या बोला कि मैं आपको आपकी लास्ट सैलरी का 50% दूंगा ही दूंगा, चाहे जो ये फंड क्रिएट हुआ है ये कम ही क्रिएट हुआ है। ये फंड हमने क्रिएट किया, कोशिश की कि ये इतना फंड क्रिएट हो जाए जिससे आपको आपकी लास्ट सैलरी की 50% के अकॉर्डिंग आपको पेंशन मिलती रहे आपकी लाइफ टाइम तक। लेकिन अगर फिर भी वो फंड सफिशिएंट नहीं होगा तो भी कौन पे करेगा? मैं पे करूंगा। क्लियर? दूसरे केस में क्या हो रहा है? दूसरे केस में अगेन बोथ आर इन्वेस्टिंग, लेकिन एम्प्लॉयर कह रहा है कि जितना फंड क्रिएट होगा उसी के अकॉर्डिंग पेंशन मिलेगी। मैं ये कुछ कमिट नहीं कर रहा हूं कि आपको 50% ऑफ लास्ट सैलरी मिलेगी, नहीं, जितना फंड क्रिएट होगा उसके अकॉर्डिंग ही आपको सैलरी मिलेगी। जब तक ये फंड चलेगा तब तक आपको सैलरी मिलेगी, अगर ये फंड खत्म हो गया तो आपको सैलरी मिलनी बंद, पेंशन मिलनी बंद। सो दैट इज डिफाइंड कॉन्ट्रीब्यूशन। शनय, क्या ये पॉइंट क्लियर होता है? Sharvil, is it fine?
Yes, sir.
Okay. Nandini, is it clear?
Yes.
Okay. Siddhi?
Yes, sir.
Okay. Great.
Sir, I just wanted to ask, new pension scheme and national pension scheme are same, right?
Generally we say new pension scheme, national pension scheme. So in national pension scheme, what happens generally, even those people who are not employee, so individuals like you and me can also invest in that national pension scheme. And generally we say new pension scheme. So again more or less the features are same. So generally we use that new pension scheme for the employees. So more or less it is same.
Oh, okay.
Now let me do. Please try all these questions. I am giving 4 minutes to everyone to complete them. You just do it. I hope it is done.
Yes.
Okay. So everyone just match your answers.
Sir, fourth, how it is A, portfolio diversification will protect against
Okay.
failure.
I'm coming. From first, second, third. Is anyone having any doubt in the first, second, third option?
Yes, मुझे first में वो लगा कि why not? जैसे I was confused between A or C. So, but the answer is B, right? So I'm confused with that.
See, compared to investing in a single security, as I told you. So what happens? For the same level of return we can earn by putting our money into portfolio with less risk. So as I gave you example that I have two options. Either I can invest in a security which is giving 20% return, and at the same time I have an option that I can put money in a portfolio which is offering 20% return. So there is a great possibility that in that portfolio my portfolio risk would be lesser. So it means I can earn the same return at a lower possible risk. Lower possible risk means lesser volatility. So that is why B is correct. Is this point clear?
Yes.
Because when we create diversified portfolio, it doesn't enhance the returns. It tells us that how can we achieve the same level of return at the lowest possible risk, or how we can achieve the highest possible return at the same level of risk. Okay. Now fourth. So fourth is portfolio diversification is least likely to protect against losses. If you remember, in the last class we discussed about it, that what happens that when there is a severe turmoil, so what happens, all the asset classes goes down. Are you getting my point? For example, what I have done, I have created an equity portfolio, and also what I have done, I have taken investment in, for example, private equity, hedge funds. So I created a diversified portfolio by putting my money into hedge funds. I created a portfolio by putting in equity. But what happened when there is a severe turmoil in the market? So all the asset classes are actually all the asset classes are yielding negative return. So there would be no diversification benefit, or very less diversification benefit. That is why answer is A. Is this point clear?
So just
They can also justify, so when everything is going normal,
yeah, then
going
I
in an equal
No.
phase, like then what is the use of investing in a defensive stock, defensive sector?
Again, there might be a possibility when everything is going right, then too, if I put my money into a single company and that company becomes bankrupt, then what will happen? And here we are talking about the severe. It means condition is highly severe. For example, if we talk about COVID situation, so what will happen? You can expect everything came down. Only if we talk about the gold, if there is a proper diversification, then definitely it benefit. Then if someone would have invested in, for example, where someone would have invested in the gold, some portion, so up to some extent it gave benefit. But ultimately what happened? The problem came. Again, if we talk about with the turmoil, what happened? Those companies which were having less credit ratings, or which were less credit companies, so again they started defaulting on their debentures. So losses. So we cannot do anything at the time of severe, we can say, turmoils. Okay, when there is a normal situation, or not, there is a down in the market, but it is not severe turmoil. It is not like that the complete economy is affected. So if that kind of situation is not there, then definitely creating a portfolio gives us benefit. Is it fine? Okay, is it done?
Sir, if the question was just likely, so answer would be B. Na? Announcement likha hai least likely.
Portfolio diversification is likely to protect against
hota
losses when markets are operating normally. When the portfolio securities have low return correlation, then B and C both are correct. Because we have seen if correlation coefficient is lower means it is going towards the negative, it is going towards the -1. So जितना कम होता जाएगा उतना diversification benefit मिलता जाएगा. और markets अगर normally operate करेगी, then too there is a benefit of diversification. So in that case, B and C both are correct.
Sir, but in case of during severe market turmoil, and we have the portfolio consisting of major part consisting of debt and gold and all of these uh, investment instrument, then how the portfolio will get affected?
So it depends. It depends how the different asset classes are performing. So when we are talking about debt as an asset class seems to be one. But again, in debt, there can be different, you can say, sub-classification. So what kind of debt we have taken, whether it is high credit debt or low credit debt. Okay, so what kind of debt is it, or is it money market debt? Okay, then again gold, how the gold is performing. So generally what happens when equity markets are down, so generally what happens, gold actually perform in positive when equity markets are down. So on an average we can say that there is a low correlation between gold as well as, you can say, equity market. So it depends upon the performance. We cannot say what will happen, but from the historical relationship, definitely we say that okay, they are negatively correlated or they have low level of correlation. So ultimately if we put that instrument also in our portfolio, so there is a possibility that it will benefit. There is never a surety that definitely we are going to get we will be benefited from the diversification always. No, there is no as such surety, but most of the times there will be benefit from the diversification. Yes, that is correct. Is it fine?
Yeah, okay.
Okay. Now, so again, so asset management means, again we can say, the mutual fund and everything. So there can be buy side firms, there can be sell side firms. So what do we mean by buy side firms? So for example, if we talk about mutual fund, they work as buy side firms. It means they buy on the behalf of their, you can say, clients. So people like you and me are giving money to the mutual funds. So what they are doing on behalf of us, they are buying. So we can call them as buy side firms. Sell side firms. So for example, there are brokers. Okay, there are investment banks who are assisting us in dealing. So we call them as sell side firms who are assisting us in dealing. So we call them as sell side firms. So we are just looking at the different, you can say, definitions. So what is full service asset managers? So they are that kind of investment managers who offer variety in their investment styles. It means, for example, there are asset managers who are managing small cap fund also, who are managing large cap fund also, who are managing, you can say, mid cap fund also, who are managing, you can say, diversified fund also, who are managing sector based fund also. So we can call them as full service asset managers. Specialist asset managers. So they are those who have special kind of style. So for example, let us say there is an asset manager who always look for value investment, who always look for that kind of companies which are value companies. So we can say, now what can be a multi-boutique firm? So for example, there is an organization firm and it has appointed different specialist asset managers. So one asset manager who is having specialty in managing fund, small cap. One manager who is having specialty to manage fund, for example, for real estate. There is one manager who has specialty that he or she can manage the fund, for example, we can say mid cap. So that kind of, it means different specialist managers are there, and a firm has appointed all those different specialist managers, and they are managing different firms. So we can call it as multi-boutique firm. Okay, yes, Sharvil.
No, sir, in multi-boutique, underwriting will also come, or it is.
No, here we are thinking from the point of view of, you can say, fund management. Okay, so underwriting is something different. Underwriting, if we talk about, so generally investment banking firms, if we talk about, so they offer underwriting services. And again, if we talk about certain financial institutions also provide underwriting services. So here we are talking from a point of view of fund management. It means it has nothing to do with underwriting as such.
Sir, so corporate treasury management will be part of like this. So there might be two kinds, na? Like one will be say personal wealth जो manage हो रहा है, and one will be even corporate wealth. That's corporate treasury का then aspect is defined under what?
It means, so you are saying there are two departments, one is corporate treasury management and one is individual treasury management, that kind of thing you are talking about?
हाँ.
तो ठीक है, हम बोल सकते हैं कि एक बुटीक फर्म है, फॉर एग्जांपल वी कैन से, बट हियर वी आर एक्चुअली टॉकिंग फ्रॉम द पॉइंट ऑफ व्यू ऑफ फंड. So basically this is from, you can say, mutual fund, that kind of thing here we are talking about. So ठीक है, इसको a point of बोल सकते हैं कि this is a kind of multi-boutique firm. It has a portfolio where it is managing corporate treasury also and individual treasury funds also they have. So we can say, okay, now there is active management and passive management. So what do we mean by active management? It means we try to outperform the benchmark. Benchmark means index. It means the portfolio manager tries to generate alpha. What is passive investment? Passive investment means simply we are replicating the performance of a benchmark. So for example, there is Sensex 30. So I am creating a portfolio exactly what is there in Sensex 30. Okay. So if we talk about most of the assets under management, it means most of the mutual fund schemes generally we talk about, or the pension fund or every, so they try to manage actively. Because if for example, logically think, if manager is simply replicating the performance of benchmark, then why anyone would invest in the fund? So everyone will simply buy the index in the form of ETF, for example. Okay, but nowadays passive fund management has been increasing. So generally ETF investing, if we talk about, that is increasing. Now, what is smart beta? So this is an approach where the manager, the fund manager, the asset manager actually try that the portfolio should earn return more than the index and risk should be lower. Yes, Shanai. Yes, Shanai.
When you said generating alpha, that is in active management, that is basically the difference between the benchmark and whatever we get over the benchmark.
Yes. That is alpha. Yes. So for example, I'm just giving you an example what happens in smart beta. So let us say there are 5 securities in the index. This is 20%, this is 20%, this is 20%, 20%, 20%. So what I am doing as a manager, I am keeping these 5 securities in my portfolio. So it is a kind of passive investment that I am keeping all these securities in my portfolio. But what I am doing, I am giving different weightage. So for example, in this index, all of them were 20% weighting. But now I am creating a portfolio of all these securities only. But for example, I am putting 30% weightage to this, 20% weightage to this, 10% to this, 25 to this, 25 to this. So for example, like that. So that is called smart beta. So I am adopting a passive approach, and in that passive approach, I am using some, you can say, active approach so that I can outperform the index. Robo advisors. So this is technology driven. It means on the basis of algorithm. So it means what are the objectives, what are the requirements. So that is put in a system, and what happens, system recommends that, okay, according to the needs, according to the objectives, according to the constraints, so the investor should invest here, investor should invest here. So that kind of robo advisory can be. So there are different aspects of asset management industry basically. Now, so I hope you must be knowing. So mutual funds, you know. So it means retail investors like you and me are giving to a company mutual fund, and they are investing on our behalf. So there can be open-ended schemes. So they can be purchased and sold at any time at the prevailing net asset value. Close-ended funds, it means they have fixed number of shares. It means they are not open to be bought and sold at any time. So they are open for a limited time period, and once the subscription is done, then it is closed and it is available to be sold after a specific time period only. So that kind of schemes are close-ended schemes. No load fund, it means there is no upfront fee and there is no redemption fee. So when we invest 1,000 rupee, so if it is a no load fund, then my 1,000 will be invested. If there are load funds, so what happens? If I am investing 1,000 and let us say that there is an upfront load, there is an entry load of 2%. So if I invest 1,000, what will happen? Only 980 will be invested. So that are called as load funds. No load, it means there is no asset charge. Exchange traded funds. So exchange funds are traded on exchange. It means exchange has created portfolios, okay, and they can be buy and sold like any other shares in the market. So they are exchange traded funds. And generally these exchange traded funds replicate something. So for example, if we have gold ETF, so simply what is happening, this gold ETF is replicating gold. So that ETF is actually managing gold. So it depends, the price of the ETF depends upon the price of the gold. So there is no as such active management. That is why management fees is less. For example, we have Nifty ETF. So it means this ETF is based upon Nifty. So this ETF is actually replicating Nifty index performance. So it means the portfolio created in this Nifty ETF is the same as we have in Nifty index. So because there is no as such active management, so management fees is generally low in case of ETFs. Separately managed accounts, as the name says. So for example, there can be some of my investors who need specialized services. Their account is big. So what it means, they have substantial assets. So we are managing their account separately. So that is separately managed accounts. Hedge funds we have already done, buyouts, venture capital funds. So all these things we have already seen. So there can be different type of mutual funds. There can be different type of pooled investments. Okay. Now, can you try all these questions? Okay. I hope it is done. Everyone?
Yes.
Please just cross check your answers. Yes. Any answer which is incorrect?
The third one, if you look at option number A,
I'm coming on it. Coming third. First and second, everyone, is it correct with everyone?
Yeah.
So can you show question number 1 for?
Okay. Compared to exchange traded fund, open-ended funds are typically associated with a lower. So what? Brokerage cost, minimum investment. So brokerage cost. See, these exchange traded funds are through Demat account.
Yes.
So because they are through Demat account, so there is a Demat brokerage. It means there is a brokerage if we buy shares and sell shares. So there is a brokerage. In the same manner, in case of ETF also there is brokerage.
Oh yeah, got it. I was yeah, I got it.
Okay. Now, which one?
So the third one.
Okay.
I was confused in A and C.
Hedge funds most likely have a stricter reporting requirement than a typical investment firm because their use of leverage and derivatives. So hedge funds generally do not publish their results publicly. That is fine. And that is what we saw, that because their performance is not available publicly, they ultimately to the indexes, if we talk about, so it is up to them whether they show their performance to them or not. But to the authorities, if we talk about to the authorities, so there might be stricter norms because these hedge funds use heavy leverage. These hedge funds use heavily derivatives products. So there can be stricter norms for them. Norms in the sense reporting requirement that you have to report.
But the answer is C in the answer section.
Answer is C. So hedge funds most likely, so this one is correct, D1 is correct, are not offered for, sorry. I'm so sorry. Hedge funds most likely, so have stricter reporting requirements. This is reporting. Report तो वो करते ही नहीं है. Yes. मुझे लगा authorities की बात हो रही है. तो इनकी अगर हम बात करते हैं तो रिपोर्टिंग रिक्वायरमेंट तो होती नहीं है. हमने देखा था इंडेक्स कंस्ट्रक्शन के अंदर भी दे मतलब it is on them whether they report their performance or not. तो ये तो incorrect है. Hold equal values of long and short securities. Again, this is incorrect. It can be, but it is not always like that. Hedge funds most likely are not offered for sale to the general public. That is correct. It means generally this is for whom? This is for the big fishes, we can say. Even for the retail investors, generally it is not available. So C, answer C is correct. Is it fine? Shana, is it fine?
Yes, sir.
Okay. So this chapter is completed.